As someone who actually lived through both the boom and the subsequent bust at various places, such as Citigroup most recently for me as their Chief Risk Officer for consumer lending, and before that as their Chief Credit Officer of Washington Mutual and the Chief Risk Officer countrywide, and 10 years at Fannie and Freddie, I can tell you that there is no question that the movie actually got a lot right for a very complex issue as it is. And yet there were a number of areas where I think further elaboration was needed to be more accurate as to what was going on during that period.
The whole housing market is propped up on these bad loans. They will fail.
The housing market is rock solid.
Yeah, so the housing bubble issue is one that many people in the movie included, certainly comes back to time and time again about how could we, those of us that were in the industry for so long, not see that materialize the way that it actually came about. And the short answer to that is that I think over the years leading up to the crisis, we had been coming through a very extraordinary period. A period marked by very low inflation, very low interest rates, and very rapid home price appreciation, and what I would characterize as a very benign economic environment. What that did was that just helped inflate residential property values over the period. It made people feel that nothing was going to kind of bring that down over the long term, and so many people simply thought that it's easy to say it now looking back and go, wow, how could we have missed it? But at the time, if you put yourself back in 2005, 2006, it would have been very hard for many people to have seen that we could have had a correction in the housing market as large as we had. Not to say that that was the right answer, but that was what many people were actually basing their opinions on.
It's a time bomb.
So Mike Burry, who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan. So
those of us that in the risk area, I mean, our jobs were to sort of call out, problematic areas from time to time or whatever we saw. And quite honestly, during that period of time, we did call for a slowdown in home prices, actually a shallowing out of home prices back to, as we say in the business, more of a mean reversion, a reversion to the mean in terms of what home prices had originally been. So a growth rate in the area of 0 to 2% we thought was actually fairly conservative. And at that time, presenting that information to senior executives and others at the board of director level, they had a hard time, quite honestly, in believing that, because again, they were looking at the actual data that was from the last several years showing rapid and continued sustainable home price appreciation, so that it didn't square with what our predictions, so to speak, were. So I like to say that we were directionally correct, but certainly we were even off at pegging how big of a drop that we actually experienced in home prices.
You know what? I'm pissed off. American people are getting screwed by the big banks.
And I am getting madder and madder.
It's unbelievable.
During this period of time, there was a systematic change in the way that mortgage products were being made, and I attribute that, I call that product morphing today. We started off from very plain vanilla type of mortgage products that were based on the fundamental, what we call 3 C's of underwriting. Does the borrower have the capacity to make the loan, that is their income? Do they have the creditworthiness, the willingness to repay the obligation? And do they have the collateral, the down payment, the skin in the game we call it, to actually stay in that property? It turned out that in the years leading up to the crisis, what was going on at many institutions was a relaxation on a very important part, which was debt-to-income ratio and assets and those kinds of things, the employment of the borrower. For the sake of trying to be more efficient. As we all know, and we still see it today, there are mounds of paper that we have to go through to originate a mortgage and sign off all these documents. And so in part it was an effort to streamline the process, but what that did was it basically allowed the proliferation of so-called non-traditional mortgages, stated income mortgages, where we didn't have a great deal of historical experience from which to draw some sort of notion of what we thought default could look like on those mortgages later on. And I think that people felt that because as long as you had a strong FICO score and you had property values that were continuing to rise, that if the borrower got into trouble, they could refinance out before they actually went into default.
There's some shady stuff going down.
Keeps on raining,
while the banks were having a big old party.
Well, here's an interesting one on that. We would not underwrite borrowers that had no jobs. It was no income, no assets. That was called a NINA loan, or ninja loans. You heard it. Some would refer to these loans as no income, no jobs, no assets. Whatever flavor of those that we had, it wasn't that there was a lack of a job. In fact, ideally we want to verify that they had income and they had employment. It was that they just were not telling us that, as long as they had a sufficiently high FICO score and they had a sufficiently large enough down payment on the mortgage.
I'm sure the world's banks have more incentives than greed.
You're wrong.
No one's paying attention.
The banks got greedy, and we can profit off of their stupidity.
Yeah, so the roles that I had were on the on-balance sheet side of the bank, meaning that a lot of what we're talking about here, the risk that was coming on for financial institutions, was coming off balance sheet in the form of derivative instruments that were tied to the underlying mortgages. So mortgages themselves would be packaged up into a pool, into a security, a mortgage-backed security that was either issued by Freddie or Fannie, which were the safest kind, or what was happening during this period was that banks themselves were starting to package up paper, such as what we call Alt-A and subprime loans, into their own flavor of a mortgage-backed security and selling that off to investors. And then what would happen is that those mortgage-backed securities themselves would be split off into new securities called CDOs and things of that nature. And what would happen is that some of those would get rated very high quality, even though the underlying assets were subprime and risky assets. They could still, in some cases, for those really higher rated tranches, get AAA ratings on them. And so people felt okay with that. So people, investors, banks themselves were manufacturing and buying these assets and feeling that they still had very strong credit quality associated with them, when in fact there was definitely a bubble going on in the marketplace that manifested itself around 2008.
Fraud has never ever worked. Eventually, things go south. When the hell did we forget all that?
What we're talking about in terms of the rating agency issue with regard to the crisis, as it's shown out in The Big Short, happens to do with the fact that there's this issuer pay model that the rating agencies have worked under for many, many years. And that creates an inherent conflict of interest between the rating agency that's putting a rating out there on either a security or on a tranche of those securities, and the issuer. In this case, it could be a large bank, for example. In that model, if a bank couldn't get a high enough rating, what they would do is they would shop it to any number of competitor rating agencies to get another view on it, and would continue to negotiate this to a point where they could achieve the highest rating on the security, which would mean the greatest interest from an investor standpoint if they could secure that high rating. So there was an awful lot of negotiation and a fair amount of I'll say pressure, if not implied, certainly that was there on the rating agencies by these issuers at the time to try to get the highest rating possible.
How can the banks let this happen? It's fueled by stupidity.
But that's not stupidity, that's fraud.
Technically, it still does, under the fact that we still operate under an issuer pay model today, and so technically it does. What you have seen, however, is that after a crisis, it's like the old phrase, in war, everybody gets religion. Well, I think everybody got religion after the crisis, and the rating agencies in particular have now sort of erred on the side of significant conservatism in their views on new rated structures, which also has yet another problem associated with it. But yeah, the fundamental issue that was there during the crisis has not been solved to this point with the rating agencies.
Have any idea what you just did? You just bet against the American economy.
If you're wrong, you can lose it all.
Up until the crisis, I was not one that actually subscribed to the behavioral finance theories. Once I started to kind of reflect on it after my career in banking, I came to realize very quickly that the folks in the behavioral economics or behavioral finance area actually have a very good view in on what some of the behavior that was taking place was all about. So let me give you an example of that. A few years ago, Dan Kahneman is a psychologist, won the Nobel Prize in Economics for something related to what he called prospect theory. Prospect theory itself, getting to how it impacted the crisis, is this: that senior managers are looking in sort of a rear view window fashion over the last several years, seeing during the boom years how good things were. Returns were great, market share was great, profitability was great, that there's no way that anything bad can happen. And that just gets to be reinforced in their psychology, in their decision making, and in the strategies that they take from a banking standpoint. And that continues to perpetuate. Compound that with another type of behavioral theory that's out there, is herd mentality. So some banks would look at other institutions that were continuing to make these no income, no asset loans or non-traditional mortgages, risky type of mortgages, and say, they must know something that we don't. And we think we need to follow them in order, A, to protect our market share, but also to continue to kind of make money in this business. And I think for those two reasons, herd mentality and this idea of confirmation bias that what's happened in the recent past reinforces your priors going forward, were two behavioral reasons for what we saw. And couple that with the fact that executive compensation was highly tied to short-term profit as opposed to the long-term viability of the institution. And I think you had the confluence for a lot of the people problem, I'll call it, the underlying issues that were associated with decision makers at the time.
The banks and defrauded the American people. Now we can kick them in the teeth.
I wrestle with that a lot, and I fundamentally, well, there's a lot of bad behavior out there, and there was a lot of stupidity, and there was a lot of misunderstanding of what, in hindsight, I think they were hearing from people like myself at the time. I personally, and I'm no lawyer, believe that there was no criminal intent for at least in the groups that I saw going on. That doesn't mean that there was extremely poor decision making and everything else that goes along with it, and they shouldn't bear some sort of responsibility for that. But overt criminal intent, I didn't see that at the time.
I'm not going to be able to refinance.
On all my loans?
What do you mean all your loans?
I have 5 houses and a condo.
Yes and no. I would say that too big to fail. There are certainly banks that have come together over time that I would almost characterize as Frankenstein banks. They're so large, they're so complex, that it's very hard for any single individual at the CEO or chairman level to really know what's going on with that institution. Should they be broken up? It's very possible that in some very isolated cases that the institution might be better off if it were being put into smaller pieces that were more understandable, more manageable, I guess I'd say. But by and large, I think that the idea of too big to fail is one that will continue to be with us for a long time and with no ready solution, I believe.